Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 436 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about something a little different. I want to do something a little different today, and I'm going to start doing this different thing every single Monday for you guys. Most of the time on this show, it is a educational show straight up. I'm trying to teach you about something. And while I think that is extremely valuable, and I'm going to continue to do so throughout the vast majority of my episodes, on Mondays, I want to spend a little time doing a little looking back at the stock market of the past week and seeing what we can expect moving forward. I want to do a little more market commentary, and hopefully that can be helpful for you guys. Hopefully that can be maybe interesting and provide you guys with a little more value if maybe you do have your financial life in order and you're just more interested in investing and what's going on and what you should worry about or why you shouldn't worry or whatever, right? I want to provide those things for you and maybe even open up this channel to another base of viewers that may just be more interested in the investing stuff. So that's what I'm going to start doing today. I'm going to start calling it Stock Market Mondays. And so we are going to dive into it today. So just stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out on these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, the things I want to talk about today are the things that are relevant right now in financial markets, right? It may not all be directly stock market related, but it's likely having some effect on the stock market, and I'll try to pinpoint what those effects are, even if they may not be completely clear. All right. So there's a few things I want to talk about, a few different topics. We'll try to get through them in today's episode. But I'll just start off on a positive note, right? For those of you who may be looking for a reason to jump ship from your investments, I'm going to start on a positive note. And that positive note is that profits soar as U.S. corporations have the best year since 1950. And this is from Bloomberg Businessweek. New data shows that earnings jumped 35% in 2021, while workers got an 11% bump in their wages, right? So this is big, right? The thing that fundamentally is going to drive stock prices over a long period of time is typically going to be profitability, right? It's going to be a firm's ability to, make something on the bottom line, have some capital that they can either reinvest in the business or return to shareholders. That's how you are going to make money. Now, this is a really big deal if you're having the best year since 1950. Now, does this mean that this will continue? Not necessarily, right? We're going to talk about some headwinds that may be in the way of this type of thing continuing. But, 2021 was a very, very solid year for corporate earnings. You had everything working, in the way of corporate earnings, right? If you have a recovering economy, you had low rates, you had accommodation by the Fed on both rates and their repurchasing of bonds from the market. You had all these different things going on, and everything was pretty clear for corporate profits to be very, very high, and the stock market followed suit as you got really, really good returns last year. Now, you may be saying, well, yes, Dylan, this is the case, but what about this year? Because this year is not necessarily shaping up like last year. And when it comes to corporate profits, I don't think that this year is going to be all that bad. I don't think it's going to be, the biggest disappointment ever, but it's probably not going to meet the big beats that we saw last year. Now, what's the S&P 500 looked like year to date? Because we use the S&P 500 typically as the benchmark, as the market index that we can look to and say, what has this done, and what should my portfolio be doing given my allocation or whatever. So the S&P 500 year to date is down 5.23% as of the close on Friday. And given that we had already been in correction territory, and for those of you who don't know, corrections statistically being 10% or more below the all-time highs, given that we were already in correction territory earlier this month, 5% down is not all that bad. And if you just look a bit more recently, right, if you just look at the past month, we're up 4%. Or if you go from Monday, March 14th close to Friday, April 1st close, you're talking about nearly 9% up in just those couple of weeks, right? So we're really on an uptrend when it comes to the market itself, and this doesn't necessarily look like a market that's going to blow us out this year, where we'll just see all-time highs after all-time highs as we've seen in our recent bull markets. But stranger things have happened. 5% down can be erased very, very quickly. Like I said, just a couple weeks and we're up 9% from where we were previously. We do that again, we're in positive territory for the year, and who knows where we go from there. Now, the bond market is also down year to date. And I think this is an even more interesting story. I said we're going to talk about the stock market. Well, obviously the bond market impacts a lot of your investments as well, because many of you have bond allocations. And the bond market, if you look at like a total bond market index fund like Vanguard's BND, you can see that the bond market's down about 6% year to date. And it's been a pretty steady bleed for bond investors. And the reason for that is the Fed, right? The reason for that is because the Fed is on the march, right? They are on this march to increase interest rates and to stop the accommodations that they were putting into the market, because as they were repurchasing bonds, as they were buying bonds from the market, they were creating support for bonds, right? Because prices would be rising. But now they stopped doing that. Now they're increasing interest rates, and as interest rates rise, what happens to bond prices? Bond prices fall. This is just not a good look for bonds as they move forward. Now, does that mean you should not hold bonds in your portfolio? Absolutely not, right? Rarely have we had a year, especially if you have some diversified portfolio, right? If you're just a bond holder, then good luck, hold your breath, do what you got to do, right? Or if you're just a stockholder, then, you really don't have a lot of worry about the bond market anyway. Myself, I don't have a bond allocation, right? I've told you guys before, being as young as I am, given that my objectives are so far out into the future, I invest in stocks only and keep very small amounts in cash other than, my emergency savings and things like that. But for those of you who have diversified portfolios like the typical individual, this is not necessarily bad news for you. Yes, it's bad news for part of your portfolio, but very rarely have stocks and bonds gone in the same direction, and that same direction being downward in the same year. Now, right now, we would be looking at a year where, if the year ended today, that the bond market and the stock market were both down for, the year. But we're only a quarter in, and things are very, very likely to change. Now, that being said, there are also the perfect headwinds in place to keep us from digging out of the hole, at least in the stock market, right? Because there's so many other things that are occurring. Obviously, higher rates are not good for growth stocks, even though they are good for value in general. And the reason that is because growth stocks are typically smaller, they're more strapped for cash, they need to be able to borrow, and the cheaper that they can borrow, or the cheaper that they're issuing new equity, whatever, then they can, grow faster and continue to grow. But when rates rise, it increases their cost of raising new capital. And so it decreases firm value. Whereas value firms that have really good cash flows, are really stable, they are winners during these types of times. But the question really comes, is the S&P going to turn positive for the year? Are we going to see a year where bonds and stocks are both down? My guess is bonds will be down for the year, but will stocks be down? I think it's way too early to tell, obviously, and there's way too many things that could occur or could turn around or could continue in the same direction that we really just do not know. Now, this kind of brings me to my next idea, because I talk a little bit about, okay, the Fed raising interest rates and the impact that this has on the stock market. Something has occurred again recently, and we've seen this a couple times in the recent past, right? We saw this most recently back in late 2019, and we've seen it occur again. Now, late 2019, I feel like there was no real way to know that this would actually come to pass in the way that it did, but it did, okay? And what I'm talking about is an inversion of the yield curve, right? And you may say, okay, well, I don't know what the heck an inversion of the yield curve is, right? An inversion of the yield curve is just literally this. It's when the 10-year treasury bond, right, which is typically going to yield higher than the lower maturities, right? The 5-year, the 2-year, the 1-year, the 3 months, 6 months, whatever, right? Because you're taking more risk by holding a bond longer. There's more cash flow default related risk there, right? So you would expect to get paid more. So the yield on the 10-year, when it drops below the yield on the 2-year, and don't ask me why it's the 2-year, that's just what this indicator is. Whenever it drops below the yield on the 2-year, meaning you could invest in the 2-year and make more than investing for 10 years on an annualized basis, then when that occurs, a recession comes shortly after. So I don't want to sound the alarm on everyone, right? But this has proven to be a pretty useful indicator. So I'll give you some historical precedent here, right? So 1978. Late summer of 1978, the yield curve inverted. By 1980, we were in a recession, right? Yield curve inverted again in 1981. By late 1981, we're in a recession again, okay? Yield curve inverts in late 1988. By 1990, we have another recession. Let's see, yield curve inverts in March of 2000. By mid to late 2001, we're in a recession. Yield curve inverts in 2006. By early 2008, we are in a recession. Yield curve inverted in August of 2019. And by March of 2020, we were in a recession. Now, that's the one I was saying, okay, how could you really tell? Because would we have been in a recession had the coronavirus not come, right? If we had just kept going in the direction that we were, maybe not, but nonetheless, a recession did occur, and this 10-2 spread really grew even to a year ago. The peak was a year ago, March of 2021. The spread between the 10-year and the 2-year Treasury bond was 1.58%. Well, as of this week, right, this past week, we're at negative 0.06. So the yield curve has inverted, and the question becomes, when's the recession coming? Is it coming now? Is it coming within 2 years? But it seems pretty reliable over a long period of time that it will come, okay? Given one reason or another, it will eventually come. So I think, this isn't a reason to really put up red flags, because there's still, you go back and look at some of these inversions, there would still be really good stock market gains to be had between those inversions and the recession actually occurring afterwards. But that doesn't negate the fact that the recessions did come. Now, you guys know, if you've watched the show for any particular period of time, that I'm a big long-term investor, and so I don't think much about like, hey, this recession's occurring. Should I put more risk on? Should I take more risk off of my portfolio? But what I will tell you, and I've preached to you guys many times about this, is that if you aren't in the proper portfolio, if you aren't taking the proper amount of risk for your particular risk profile, right? Because we all have our own risk profile, the amount of risk we're willing to take for a certain amount of return without just jumping ship when things go bad. Okay, if you aren't taking the proper amount of risk, right, and a recession indicator just blinked, a pretty reliable recession indicator just blinked, and then we have a recession, and we have let's say a bear market, which some would argue we just had a bear market, and we definitely are, coming out of one in the NASDAQ. But nonetheless, it's going to put you in a position, if you have the proper portfolio, to not jump ship when things go awry, right? Because you guys know that time in the market is better than timing the market. So I don't want you to try to time the next recession. That's not the point of me talking about this. This is just me saying this data hasn't lied over the last, I don't know, nearly 50 years. And so if, we just go back that far and see all the recessions, they happened after the inversions of the yield curve. So this is just something I think is interesting, and something that may, put you in a place where you should actually go and pay a little more attention to, your portfolio and exactly the risks that you're taking. Now, you may be asking, well, what even causes the yield curve to invert in the first place? And the big causes are pretty clear, right? If the long-term rates are lower than the short-term rates, right? What does the Fed have the most control over? It has most control over the short-term rates, right? Well, what the market is telling us is that they don't expect the short-term rates to bleed into the long-term, right? They expect the Fed to do what it has to do in order to tame inflation. We know inflation's a big headwind right now, and is why the Fed is doing what they're doing with increasing rates, taking away accommodations, things like that. Right. And so if the Fed is going to do what it needs to do, it's going to impact the short end of the curve. But the market's saying we're not expecting strong enough growth over the next 10 years to warrant that rate going higher than the 2-year. Right. So trying to perfectly explain this or perfectly get it to a point where it can be traded upon is very, very difficult. But nonetheless, seeing this recession indicator hit, something I think is interesting and something you may want to look into. Moving on, right? Let's move to something else. If you thought that recently we'd been in dire straits in markets, you're not right? First of all, we've been in much worse situations, but it wasn't a whole lot of fun there for a little while, right? If you go from January 3rd to March 14th close on the S&P 500, it was down 13%, right? Being down 13%, let's say you just hold an S&P 500 index fund, it's no fun, right? But we have to back out a little bit and look at things with a little more perspective, right? If you backed out a year, right? If you felt like that just negated the past year's returns and we're not doing as well anymore and all these types of things, if you go back a year, the S&P is still up 11.48%. Right, which is fantastic. If I was making that year over year in the S&P 500, I would be absolutely thrilled. And you've made more than that in the last 10 plus years if you were invested in the S&P 500 only. So we can't get too bogged down in the fact that things had been bad recently. But something that I wanted to talk about were rolling returns of the S&P 500, and this is something that Michael Batnick put out, who has the Animal Spirits podcast and the Compound and Friend podcast, works for Ritholtz Wealth Management. And basically what he did is looked at 10-day rolling returns of the S&P 500, basically saying take a 10-day period, then you move a day, the very next 10-day period, you move a day, the very next 10-day period. And what he was saying is that since March 14th, if you take that 10-day period right after that, that run is as good as anything that's been seen. That 10-day rolling return was the best 10-day rolling return that had been seen over the last decade if you just took out March of 2020 lows, right, which was coronavirus crash lows, because there's a big dip in 10-day rolling returns and a big spike upward from that. But this, we're pretty tame in what our 10-day rolling returns had been, and then you get this shoot upwards of over 10%. So I think this is something to be very optimistic about, right? Something to be very bullish about the fact that, we went 13% deep into this, correction and what some people were calling a bear market, because, the market was being held up by just a few stocks, and the NASDAQ was in a bear for sure. and then you have a big jump. And you just go over and look at the NASDAQ for a second. If you look at a 1-year chart of the NASDAQ, it's only at 4%. So the S&P is outpacing the NASDAQ on a 1-year basis. Year to date, the NASDAQ's down almost 10, right? But from the March 14th lows, the NASDAQ's up 13.36%. So this is something to be very optimistic about, and just to know that downturns don't last forever. And not only do they not last forever, typically on the other side of any type of significant downturn, you get some significant upward spikes in stock prices. So I think that's very interesting, and it's a big bounce that didn't necessarily continue this past week. This past week was pretty flat in the market overall, but it's something that I think is something to be thinking positively about. Not so worried that we're going to have a continuation into correction or bear market. And guess what? Even if we do, just keep buying. Right? Just keep buying at these lower and lower prices, and you will be okay. Now, a couple more things in today's episode I want to talk about. We haven't talked much about this as of late, and this could turn into a very positive thing for markets in the weeks to come. But the impact that war has on equities is just not what you would expect, right? If you go and you look at the negative returns of the S&P 500, right, around major negative geopolitical events, you would be very surprised to know that the S&P 500 does not negatively react very much at all. And I've talked about this before, and the days to recover from a negative reaction is amazing. I think one of the biggest ones in my mind is if you look even at the Kennedy assassination in 1963, the S&P 500 was down 2.8% at the trough. And then it took 1 day to recover, right? That's how long it took to recover from a president being assassinated, which is just an amazing thing, right? So nonetheless, war shocks, they don't have this big impact on equities. Now, that being said, on the other side of that is the fact that if, this, war shock goes away, if there is a ceasefire, if there is, calming of tensions between Russia and Ukraine, then you could see, big bumps in asset prices in the short term. And that would be fantastic. And you may also see, big decreases in oil prices in the short term, which would be good for consumers, which would be good for stocks and all, the things right on down the line. So, which would be good for inflation, all those types of things. So, I think if we do see some type of ceasefire in the near to intermediate future, then you could expect a little bump in stock prices that may not have been foreseen otherwise. But if that type of thing happens, I think it's a very good positive catalyst for markets. But who knows the exact upward impact that it would have to get this type of headwind out of the way. I still think the biggest headwind in our way is not the war, is not Russia, Ukraine. I think it is the Fed. I think it is inflation, right? Is the Fed going to do what it needs to do? Is what it needs to do going to put us in a place where we're not going to be able to make the returns that we would otherwise be able to make, right? All these things together, I think those are the major headwinds to worry about. But otherwise, like I said earlier, coming off a year with amazing corporate earnings, likely still going to have some pretty good earnings moving forward. I don't see, tons of negative things outside of inflation and the Fed here. So those are things to definitely be looking at. Now, the last thing I really want to talk about in today's episode is the National House Price Index, right? The Case-Shiller Index. So if you don't know what the S&P Case-Shiller Index is, it's basically this index of home prices that covers all 9 U.S. Census divisions, and it reports every single month what the increase in home prices is, or it gives some type of index, right? Some indexed home price value. And if you look year over year from January, right, the data is kind of backdated, right? You don't get the data immediately upon the ending of a month. So if you look at the January data, right, the January data shows a year over year increase of 19.2% of home prices, right? 19.2%. 18.2%, which is up from 18.9% in the previous month, which are both just outrageously large numbers. Now, Phoenix, Tampa, and Miami reported the highest year-over-year gains among the 20 cities in January, which this is not surprising. You're seeing, two of those are in Florida, which has no state income tax and very, lax, COVID rules over the past couple years. Phoenix, that's where a lot of people go to retire. So this is not super surprising. Phoenix led the way with a 32.6% year-over-year price increase, followed by Tampa with a 30.8% increase, and Miami with a 28.1% increase. And you just have to think about this. That's not saying all the homes in Miami or all the homes in Tampa went up by that much. What we're saying here is likely that most homes went up just marginally, right? But you had these homes that are towards the top of the price range, doubling, tripling in price, which is just outrageous, and it drives this average. Now, before seasonal adjustment, the U.S. National Index posted a 1.1% month-over-month increase in January, while the 10-city and 20-city composites both posted increases of 1.4% per month. Now, home price changes in January 2022 continued the strength that were had for much of the prior year. The National Composite Index recorded a gain of 19.2%. Last fall, we observed that home prices, although continuing to rise quite sharply, had begun to decelerate, even that modest deceleration was on pause in January. And this increase was the fourth largest reading of this index over the 35 years of history. So this is pretty significant. Now, then the question is this going to continue? I know you guys get real interested in housing prices, and I myself am very interested in housing prices, what drives it, what's most interesting. And even with increasing interest rates, right, we're seeing this occur. Because if you don't know, interest rates, especially on like 30-year mortgages, have increased quite substantially as of late. Now, this is as of January. I would expect February and March numbers to be lower, and I would be shocked if they weren't lower than this by a substantial margin, due to the fact that the Fed did raise interest rates. They took away some of that uncertainty. Raising interest rates decreases the demand for mortgages, which decreased demand for mortgages is going to decrease housing costs. Not necessarily decrease housing costs, but maybe slow the increase in housing costs over time. So I think this is very interesting as well. Now, could the housing market have any substantial impact on the stock market? I mean, it's this whole thing of, if you're spending all this money on your house, you have less money to invest, which means that stocks don't go up as much, maybe, right? If everybody's just overspending on homes, but maybe not as well. I think, again, this goes back to the big catalyst being the Fed, being raising interest rates, and the market reactions to said things. So a lot of that is just a wait and see game. But nonetheless, I think there's a lot to be optimistic about. I think there's a lot to be looking forward to. I think that everybody's interested to see what corporate earnings are going to be this year. I think we're interested to see in what the beats look like. We're interested to see what this 10-2 inversion turns into. All right, but always be optimistic of the fact that we do have a very resilient stock market. We do have a lot of consistent buyers, including myself and hopefully yourself as well, that are going to keep stock prices moving up over a long period of time. And ultimately, we've had great fundamentals that have continued to drive stock market prices up and up over long periods of time. And truly, over long periods of time, we've had a very accommodative Fed, even though that may change. And I'm very interested to see how that type of change may impact asset prices. But nonetheless, this is your first Stock Market Monday. Really let me know what you think about this. Let me know topics throughout the week, or topics that I may have missed that you're interested in. You leave those down below in the comments, and I'll be sure to talk about those types of things. But this is what I want to give you guys. I want to give you guys a little bit of commentary. I want to tell you some things that are going on and some things that are impacting markets, and things that you may want to take with you as you go and learn a little more about and look a little more into What I don't want this to turn into is me trying to forecast anything or tell you anything about the future, because I don't know, right? We can, speculate as much as we want, but ultimately I want you guys to be good long-term investors who focus on the positives, who focus on the good things and the things that are going to get us to building wealth over a long period of time. So hopefully you enjoyed this video and you will continue to tune in for Stock Market Mondays. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I get back to the more educational things and teach you guys about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.